Hello, welcome listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today we have a special podcast with Ken Egan from our Sovereigns team.
Hello, everyone. Thanks for having me on, Gordon. I'm looking forward to the discussion.
This is the second of our special Conversations in European Credit. These occasional discussions that we have focus on a prevailing topic in the market with an economics focus. Ken and I will cover a more macro topic to our usual more sector-focused conversations and provide you with KBRA's thoughts on the current state of events, where things are going, and why. So sit back and enjoy, or if you're feeling up to it, reach out after listening and keep the conversation going. For those of you new to the podcast, go back and have a listen to our discussion on interest rates on the 21st of March. You will definitely enjoy it. Right, let's get things started. Ken, we've had some great weather recently after a pretty bad end of the winter. And I know you are a keen angler. Did you get out fishing at all over the weekend?
No, I didn't, Gordon. Since the little one arrived, my time for fishing has evaporated before my eyes, as you can imagine. Different weekend activities these days, but it's still all good.
Yes. How is the little one doing?
Yeah, great form. She's learned how to sleep at night, so that's just been the best result imaginable for everybody concerned.
Yes, I remember those days well. Each stage comes with its challenges, but fantastic rewards as well. So enjoy.
Yeah, and what about you, Gordon? I believe you're gearing up for the big annual industry event.
Yeah, we're about to head off to a hopefully sunny Barcelona for the annual IMN Global ABS conference. It is quite a slog, but in a good way. Loads of meetings, conversations about the market, etc. But I am always so impressed at how engaged everyone is with us as a up-and-coming agency in Europe. Now, Ken, let's turn our attention to the topic at hand for this episode and one of focus for the credit markets, the labor market. It's something we are particularly focused on at the moment, as it's very important to watch due to its impact on the performance of credit and as an influence for many different credit channels. As of right now, there are many different angles to look at this. It seems that some distortions in the economy are in fact a delayed result of labor market dynamics. Maybe we can quickly start with an outline of the broad picture of what is happening right now with regards to the labor markets.
Yeah, now to most of your listeners, we might be hard pressed to make the labor market a really engaging listen, but trust me, Gordon, there are a few interesting little nuggets under this theme at the moment.
Oh, believe me, this is not boring stuff to us credit nerds. Typically, with current market dynamics, we would expect to see a sharp uptick in unemployment in order to bring down inflation. And from a credit perspective, this is something we have all been anticipating as it impacts on performance. We commented on it in both our 2023 and 2024 sector outlooks, but instead, in many regions, we are seeing falling inflation, in some cases below target, while unemployment remains around record low levels. The labor markets are definitely tight.
Yeah, we have tight labor markets despite 10 hikes. And bearing in mind the high interest rates constricting the economy, or at least trying to, the labor market has performed well. And if anything, we have labor supply issues, demographic problems, which are getting worse, combined with stable or stable-ish economies and a general demand for jobs. Also, there are underlying themes supplementing this that are gathering pace. For example, immigration is needed to help the supply of workers, but in part, due to the pace of change on a population, we are seeing demands on governments and a shift towards right-wing politics. So added to this, there is still a hangover in some regions from COVID. Plus, we have artificial intelligence looming as a threat to the need for human workers. There's a lot to unpack within this current labour market, and it has become so complex.
Okay, that is a lot to unbundle. Let's start off with a look at Europe as a whole, more specifically the Euro area. Here, headline unemployment numbers are at their lowest rate since the start of the Euro area at 6.5%.
Yeah, which is maybe contrary to what you might expect after so many interest rate hikes.
Exactly. If you look at countries that suffered in the post-financial crisis, like Spain, where unemployment reached as high as 26% in the post-global financial crisis world and are now down to 11.7%, or even stronger is Portugal and Ireland, which peaked in the teens and are now down at 6.5% and 4.1% respectively. As we already mentioned, the labor market is tight. In some countries, you even have employment growth actually outpacing GDP growth, which weighs on productivity. So let's dig into the growth side first and get the brass economics out of the way. So what is happening to European productivity?
Yeah, I'd say the capacity of the euro area economy is perhaps outstripping the supply of workers to fill the jobs, as the labor market is largely at full capacity. And this gap then weighs on productivity, as you say, and this aspect is particularly interesting. There are two sides to the coin here. So it's a case of having employers paying higher wages to try and attract staff. We know labor costs are rising in Europe. And then dimension this against the actual output we see. On the contrary to this, we have seen examples of firms saying, no, we can't get the staff we need. We're going to go the AI route, invest in technology and automation instead. And just to highlight, in Germany in particular, there are a host of companies trialing a 4-day working week now in an effort to raise productivity in the context of a lack of workers. So you can see how the labor market is changing. Firms can't get workers using traditional methods, so they have to innovate and be creative. A 4-day working week in a hope to lift overall output or invest in automation and technology. I guess I just add a note for listeners. It can be hard to measure productivity in Europe across these advanced economies, especially when you consider the tech side of things like intellectual property. But I guess a general rule of thumb is we can always be doing something better.
Well, part of what we're seeing right now is also related to the pandemic and the impact it had. COVID kind of changed the game and the thinking of businesses and individuals in general, didn't it? And this has had an impact on the workforce dynamics.
Yes, it definitely did. It led to labor hoarding. There wasn't a natural change of staff. Firms could sit on cash, borrow at low rates, and wait it out. There was no investment needed and no development pipeline. Digitalization also went through the roof during the pandemic lockdown. So other areas of investment fell behind, weighing on productivity. And this, as you say, all feeds into growth. A growing angle on the digitalization side is automation. The more artificial intelligence we introduce and the more tech we invest in, let's say in terms of the auto industry, as an example, if we look at electric vehicles, the lack of investment, partially due to demand, it must be said, by German automakers means they're being left behind by their Chinese and US counterparts who are far surpassed them in the EV space and are now more productive. And this means a shift towards greater tech investment in the industry and greater automation within Germany. Does this then remove the need for physical workers on site from the industry, creating perhaps a fiscal cost? The flip side is that it could improve productivity for those in the tech sector to compensate for the lack of it elsewhere.
Right. But this shrinking demand for physical workers should drive up unemployment, no?
Yes, it should, but it's not a perfect correlation. So while on one hand we are replacing some of the physical workers, on one side there are AI or technology jobs that are generated by the demand for productivity improvement on the other. This will partially offset the unemployment created by the innovation. However, there would be an increase in unemployed auto workers using our example, and the replacement on the tech side would not obviously be one for one.
Going back to what we spoke about earlier and the capacity for the economy and growth, how do higher rates impact the current labor market, given some of the dynamics we just covered?
Yeah, I think higher rates are dampening the more dramatic effects we might see from labor market tightness. I think the liquidity position of corporates and FIs has improved in the post QE world. So they are in a position to be able to just sit and wait or hold staff. Fiscal intervention, has also helped here too. The vacancy rate has dropped slightly in the last few quarters. And just for those who don't know, the vacancy rate represents the amount of open jobs or unoccupied in the market yet to be filled. Since the start of 2022, it's averaged 3% in the euro area. The latest quarterly reading showed it declined to 2.7%. So a bit less demand out there now that we've had higher rates constricting credit in the economy for a while. Having said that, the long run average over, say, 10 years, the vacancy rate in the euro area is 2%. So we're still quite elevated compared to that. And to me, it is a case that higher rates are doing their job in terms of dampening demand and loosening to some degree the labour market. But the more structural issues remain, the supply issue. And I think as rates ease, you'll see these issues reappear more prominently. We still have our base issue, right? The lack of supply of workers and changing demographics.
Okay, so we need workers. Demographic changes for most of the Western world means that our workforce is shrinking. Do we need to look to overseas workers?
Yeah, I mean, well, look, let's put it into context. Like falling fertility rates, fewer children being born, rising life expectancy in Europe, which has risen from 73 years of age in 2000 to 79 now, are all influencing the supply of workers. Sick leave is also a big theme since the pandemic, especially in the UK. I think the number of working age and active people due to long-term sickness in the UK has jumped 40% since 2019. But more generally then in the EU, more people have upskilled during the pandemic. Many of them left the workforce to take early retirement. So there's different factors at play. But I think from an economic perspective, yes, the workforce does need migrant workers due to demographic trends we just mentioned. And just on this, Germany recently passed a law to attract skilled workers to the country. And this immigration reform bill is meant to tackle labour supply shortages directly because so many companies in Germany complain of unable to fill positions, a lack of skilled labour in the market. And as we said, vacancy rates have moved much higher.
This is a controversial area and certainly not new. The migration of workers is in part what supported the Brexit vote. Most populations do not like to be overwhelmed by an influx of immigration. Given the huge political angle here, how realistic is this to happen and to help?
Yeah, exactly. And remember, half the world are going to the polls this year, and we're in an election cycle, as you hinted. Right wing politics are on the rise, especially in Europe, whereby immigration has become a big theme. Europeans will go to the polls very soon, June 6th, to vote in a new 5-year European Commission. Immigration will be a big theme there, even after the recent migration and asylum policy reform. In terms of elections that have already happened, look at the change we're seeing in terms of right wing parties, which have strong views on immigration policies. Homeland Movement in Croatia gained 9.2% of the seats and joined the ruling coalition. Chega in Portugal went from 7.3% of the vote in 2022 to 18% in 2024. That's just 2 years of change. And then AfD in Germany back in 2022 were at around 10% in the polls. Now they're 18%. And Brothers of Italy are in power in Italy. I think that's part of the issue, right? Considering Germany's recent bill, it's a case of skilled workers versus asylum seekers. And in the political world, this seems to be quite blurred at the moment. And then within that, you have certain barriers to entry in terms of actually joining the labour force. For example, a non national with a degree can access the blue card work permit in Europe. But if you've no degree or qualification, you fall into a different tranche, and so on and so forth. I think as the situation worsens, you'll see some of these barriers streamlined and broken down. I think Poland is a big success story. Poland took in a massive amount of migrants after the Russian invasion of Ukraine, over 1 million people. And the figures show how well absorbed migrants are into the workforce. Over 60% of migrants enter the workforce, and the majority work 50-hour weeks for minimum wage. So you can see the impact this then has on credit metrics like labor intensity and productivity.
Right, which brings us back to the shift in demographics. And despite the lack of willingness, the need for immigration, the demographic shift without labor force expansion puts pressure on governments to cope with an aging and retiring workforce.
Yeah, exactly. And hence the painful reforms, such as those for the pension sector in France recently, it's just too costly without reform. I mean, for France, the state already allocates 14% of GDP to pensions annually. For context, the economy there is 3 trillion euros and is one of the largest in the world. And all these figures are projected to get worse or larger. Italy is in a similar boat. State pension bill will go above 17% of GDP over the next 15 years. Ireland is the same again. Pension expenditure will double over the next 30 years, and it has one of the fastest aging populations across the bloc. Another way to look at Ireland is the old age dependency ratio in 2023 is 1 retiree to 4 working age people. By 2050, this forecast will be closer to 1 to 2.
Okay, but what does all this then mean for sovereigns?
I think there's a few different angles here. As we discussed, how productivity and investment feed growth, I guess a lack of migration eventually places fiscal pressure on governments in terms of an aging workforce and pensions. This will be key. Rising social and age-related costs are facing the state. The government needs workers to generate income and pay taxes to help contribute to the pension system and pay for healthcare. Furthermore, as AI embeds itself into the economy, you have this alternative threat, then creating even more pressure on the demands of the state, as idle workers whose jobs are replaced may need the state to step in and provide for them or retrain them. It's like having a load of would-be workers waiting for jobs in the desert, but the hiring manager is only looking for a fisherman. The point being, we can't have an economy with just skilled technicians.
Good point. Your fishing skills would be in demand, though. Anything else on the sovereign side?
Inflation impulses from wage growth too, perhaps, as we've had recently. Per capita income growth could also see an impact. Sovereigns becoming wealthier as higher incomes result in wages pushing employees into higher tax brackets. And just to add as an aside, the IMF wrote about this in the context of Latin America recently, but I think it's true of Europe, that slowing labour force growth will weigh on the economy. Demographics are impacting growth and dragging down forecasts. So this could have an impact on corporates too, not just governments. It will feed into different credit channels. For example, think of a corporate that was planning an investment in a given jurisdiction is based on historical growth projections, and these are no longer accurate and need to be reevaluated.
Just on inflation there, you mentioned wage growth. This has been a major contributor to ongoing inflation. Goods inflation has slowed dramatically, but services inflation and wage growth remain high. Will we continue to see ongoing growth in real wages this year? And will that continue the higher for longer for both inflation and rates?
Yeah, I think it's a concern of central banks for sure. And we have seen serious growth in euro area wages relative to the past. It's jumped by over 3% in a short space of time, a few years. So it is elevated, and we have heard policymakers discussing it specifically. I think to put it into context, it's probably not as structurally strong as economists initially thought. And in fact, nominal wage growth seems to be in decline already, according to some trackers. But yes, we will see real wage growth this year as inflation recedes, but maybe this won't be as potent as once expected. Again, maybe it's yet another dampening effect from tighter monetary policy and action. The Indeed wage tracker is a good wage indicator. It follows new job postings, and the 3-month rolling average year-over-year growth figure for the euro area at the end of the first quarter was 3.7%. So inflation was around 2.4% then, giving you modest real wage growth. Drilling into this, wage growth in Germany end of Q1 was 4.1%, and inflation was 2.3% in Germany there, so quite sizable gap. We see smaller real wage growth patterns in Spain, France, and Italy. But the theory is correct. Tight labour markets, upward pressure on wages feeds inflation. At the moment, though, it's just not as strong as initially expected. However, in the UK, the labour market has consistently been tight, and this has led to persistent upward wage pressure. Wages are growing strongly now. Weekly earnings are growing at around 6% nominally, and this feeds into that greater inflation impulse in the UK, which we spoke about before, and probably why the Bank of England's easing cycle looks slightly staggered compared to the ECB's. The macro impact of all this is, however, that instead of inflation being a tax on growth, fast-paced real wage growth acts as an impetus on growth, consumption-led growth. That's been some of the explanation behind the better-than-expected macro performance across euro area sovereigns.
The euro area has regularly struggled with productivity, though, right? Ever since the introduction of the euro area over 20 years ago, when one economy shows improvement, others drag the aggregate down and vice versa. At one point, the EU introduced something called the Next Gen EU funds, which was meant to tackle some of this. What impact did it have, and where do things currently stand on this front?
I think more generally across, say, Italy, France, and Spain, as 3 examples, we've seen the labour market reforms, grease the wheels and generate greater participation, which has happened for sure. Now, some of these reforms have been from domestic policies, but the public investment from the EU that you mentioned will enhance them. In Spain, the shift away from temporary contracts, for example, or in France, apprenticeship reforms, contract reforms to make the labour market more flexible. And then the EU Recovery and Resilience Facility will build on this. For example, in the context of France, the EU will provide 84% of the hiring subsidies for young people below 26. Employers hiring a young person in France below 26 receive up to €4,000 per year for a full-time contract. Here in Spain, a big part of the Spanish plan is upskilling and reskilling. And in Italy, there will be a big focus on education and pushing people into tertiary level education. I'd say a common theme across Europe is labour market flexibility, getting rid of rigid contracts and agreements and making it easier for firms and employees to change and move. I guess the thing is, this is preparing for the future, the next generation, as the name implies. The change will not be instant, will take time, which we might not have on our side.
Many thanks, Ken. That was a very interesting conversation.
Yeah, my pleasure as always, Gordon. I can't wait for the next one.
Me too. Thank you very much to our listeners for joining us on this journey to cover a topic of great interest at the moment. If you want to carry on the conversation, please feel free to reach out to either myself or Ken. We'd be very happy to hear from you. That's it from us today. As always, we hope these conversations in credit help to illuminate the many trends taking shape across the markets. For more in-depth coverage of the themes discussed today, or to learn more about our unique approach to credit, Sign up to the KBRA website and read all our research. Have a topic idea or comment you'd like to share, or if you feel inspired for a discussion based on the conversation you just heard, reach out to me or one of the KBRA analysts on today's episode. Be sure to rate, share, and subscribe to the podcast so you can be notified when new content is available. Invite your colleagues as well. We'd love to count you all as informed listeners. This is Gordon Kerr thanking you for being part of the conversation. Take care, everyone.